The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Welcome to Squawk Box Europe. I'm Karen Cho with Silvia Amaro. These are your headlines. European equities search for direction in the final trading day of the year, with the benchmark Stoxx 600 on pace for its best annual performance since 2021.
Silver moves lower, marking a turbulent end to a year that has seen the precious metals price rise by almost 150%. And Ukrainian officials look to quell a diplomatic storm as they deny an alleged attack on President Putin's residence. And Russia deploys nuclear-capable missiles in Belarus.
It has been a roller coaster year as we look back over 2025, the Liberation Day sell-off, the market regrouping, huge moves out there in various asset classes, even in Europe, defense stocks, banking names. I mentioned earlier that if you've not made money in this market, then I don't know what you're doing, because even if you were in crypto, there are moments to be nimble, to capture the highs and bank some of those profits. We've seen it in the metal space into year-end, commodities as well. Some of the big tech story has been around the AI development, and of course the semiconductors up about 50% if you look at that ETF.
So it has been a strong year across the board, but let's take a closer look as to what's happening this morning. In Europe, it is the final trading day after all, and thinking about some of the moves here, at this hour we are seeing a little bit of pressure for some of the European bourses, but ultimately we have to keep in mind that we are dealing with lower volumes today. Germany and Italy are closed for trade. Paris and London also have shortened trading hours today, so that is important to keep in mind indeed as we look at some of these numbers. But nonetheless, and as we've highlighted, it has been a strong year for European equities. So let me show you the details here and how we have been performing across the board. Ultimately, looking at Italy, looking at Spain, some strong momentum here for some of these markets. In Spain, we're on track to see gains of almost 50% on the year. In Italy, the main market also on track to see gains of about 30%. And it's only in France, ultimately, that we are looking at a little bit of underperformance versus the rest of Europe. And all in all, when you think about the benchmark, the Stoxx 600, we are on track to see its best year since 2021. But let's look at the different sectors too and understand what's happening in terms of some of the corporate moves and the sectorial moves here as well. These are, for the moment, the best performing sectors this year in Europe. You have banking at the top. A lot of considerations here about where we are in terms of the consolidation efforts for the banking sector and whether that could propel this industry further in 2026. But thinking about 2025, we are on track to see gains of almost 70%. Basic resources also benefiting from the recent moves in terms of metal prices, and utilities also on track to see gains of about 30% too. But let's take a closer look at the banking sector. It's an important one to look at because, of course, banking tells us so much about the European economy as well. I want to look at BBVA because this has been a bank that has strived to consolidate, has tried to get bigger, but despite the failed attempts there, it is on track to see gains of about 112%. Commerzbank has also managed to, so far, defy expectations of a potential move from UniCredit in this space. Commerzbank on several quarters posting very, very strong numbers, and at this stage on track to make gains of about 130%. But the top gainer at this stage is actually in France, with the Société Générale on track to make gains higher than 150%. In terms of the worst performing sectors, let me show you that too, so you get a full picture as to what has been happening this year. Media under a lot of pressure. It is the worst performing sector so far this year. A lot of that related to the struggles that this sector is facing in terms of keeping up with AI developments, but also autos and chemicals and the pressure. Let's see whether the narratives could change for some of these sectors in 2026.
I'm just going to say it was not a Santa Claus rally here in Europe. We went sideways on the German stock market into year end. You had parts of the market that sold off in December, recaptured some of that territory. But, you know, it was a fairly banner year, whereas we take a look at the performance for Europe. So there's nothing really to moan about, but we just didn't get that end of year sizzle. The Asian markets, as we take a look at them as well, I mean, the Japanese stock market, again, very similar. You had this huge run-up post-Liberation Day. That really peaked as we went into November, and then you saw the market come off a little bit and go sideways. So, again, it was not a Santa Claus rally for some of these markets. Japanese stocks, though, very strong year. The standout was the South Korean market, gains of well over 70%. That seemingly, again, tied to the AI, the technology broadening out story that touched the sides of the South Korean market. And don't forget, Trump went to Asia, and some of the big deals that were inked that included local companies, the likes of SK Hynix, Samsung, really carrying that market forward. Chinese stocks too trading stronger. Blue chips are about 18%. And the Hong Kong market got going up about 28% too for that Hong Kong market. US market year to date, mixed fortunes across the board, about 13% so far on the Dow year to date, eclipsed by the S&P 500 up more than 17%. But it was, of course, the tech-heavy Nasdaq, gains of more than 21% so far for the year. So stateside, if you're positioned around tech stocks, that is where you saw the best returns. In terms of the sectors, this is how it played out. Communication services encompassing a lot of those big FANG stocks, stronger, as you can see, more than 30% to the upside. Technology itself, more than 20%, but mixed performance, don't forget, from some of the big tech names where investors got a bit nervous around fears of an AI bubble. Palantir at one point coming off, but still very strong performance. Micron and the semiconductors. Alphabet, it was the Warren Buffett or the Berkshire Hathaway story that bolstered that company to year end as everybody clocked the Google effect and just how strong it has been with Gemini. Nvidia, again, another banner performance for the stock, backing up after a strong year the prior year. Let's move on and get to David Roche. David Roche is president of Quantum Strategy. David, I'm not sure this is what a lot of the viewers want to hear as they're gearing up for celebrations after a very strong performance on markets, but you're warning that going into next year, there are disruption risks. Just spell it out for us.
Well, I've looked at the forecasts for next year, and they're all, if you take the bigger banks' forecasts, they're all very close to each other. And it's really a repetition of this year, which is you get, 3% growth and inflation goes down to 2%. And central banks cut interest rates and we all live happily ever afterwards. And there doesn't seem to be anything thicker than a cigarette paper between the individual views which make up that consensus. So I think that's wrong. Now, why do I think it's wrong? I think there are a lot of things that can go wrong. First of all, the unrepeatable nature of the happiness we had last year, where tariffs didn't create inflation, Trump calmed down a little bit, the Fed cut rates, and the economy continued to grow relatively strongly and profits went up. I think that probably is not going to be repeated. That's the first disruption. The second is, I think there's going to be a battle for central bank managers. Who's going to actually manage central banks? Is it going to be the politicians or the central banks themselves? In other words, central bank independence, which I suspect the Fed will lose. And I think that'll undermine financial markets and undermine the dollar. The third is we're going to see a big drive by China to replace the US dollar for its own international trade, which will be another step down in the dollar's role as an international currency, which will be negative for assets around the world, but particularly for US-based assets, US dollar-based assets. And third of all, as you were talking about earlier, the transatlantic alliance looks very fragile. Trump doesn't seem to want to really deliver on US commitments to NATO Article Clause 5, mutual defense. And I think the Russians are gearing up. You've seen it yourself. New nuclear-capable missiles in Belarus, a ridiculous kind of idea that Zelensky is stupid enough to try and dump drones on top of Putin's ill-gotten palaces when he's just about to agree to a peace deal with the US. I mean, that's just a false flag operation par excellence. We've got the natural bursting of bubbles, AI, and excessive credit, non-bank financial credit in the US. And we've got Donald Trump thinking he's going to slice up the globe like a big fat turkey, and he's going to take his sphere of influence and do what he likes in it, be it from Nigeria or be it Latin America. And Putin probably thinks he's going to do the same in Europe. And President Xi may decide, to add Taiwan to his little sovereign territory certainly before the end of 2027. So what I'm saying is, look, if you look out there, the consensus forecasts, which are that everything gets repeated, everything is very calm and very nice for financial markets, that consensus is probably wrong. You only need to get one or two of these 8 disruptors happening, and you're going to have a very different type of outcome for next year, which I think will result at the end of the year in a drop of 20% in equity markets.
Well, David, that is certainly the bear scenario, isn't it? And this year didn't play out how the market thought it would. So a word to those who are sitting comfortably and getting ready to pop the champagne this year. I want to pick up the point around Trump. And you make the point that Trump has peaked. These are your words. As his power declines, he'll get more maverick in his policies. Can I push back around this? Because you make the point around geopolitics, foreign policy. Even if there are more challenges domestically going into the midterms, couldn't Trump just pivot, switch focus, try and solve the war in Ukraine, solve some of the other burning issues, Nigeria, Venezuela, double down on the foreign policy to get some wins, and ride on the back of the BBB, this big, beautiful bill that may provide some sort of fiscal tailwind into the US?
Well, you're perfectly right. If I can begin at the end of what you said, is perfectly right that the BBB Act will provide fiscal tailwinds to profits. But on the other hand, there are a lot of things he's going to do domestically. He needs to become a beloved of ordinary people in the street with houses and mortgages. And to do that, he has to force the Fed to reduce interest rates and try to get long-term interest rates down as well. And I think that's where his domestic policy will come unstuck for financial markets. It's fine giving fiscal handouts to people who support him anyway. It's not fine trying to mess with the Fed. So I would say that's probably where that could come unstuck. In international affairs, he can't fix the war in Ukraine because Putin doesn't want to fix it, and he'll just wind Trump around his finger as he's been doing, and it'll go on being a catastrophe. So I don't think his international, I've fixed 8 wars, which is a load of fiction anyway, is going to extend to actually fixing the Ukraine war next year. But what I do think is he'll get fed up with it. He'll get fed up with the Europeans, and he'll walk away from Europe, which of course creates the sort of vacuum which Putin, not being a fool, will seek to fill within a couple of years. So that's why I don't think it's fair to say that all these disruptions can be good disruptions. I think some of them are bound to be bad enough to make things a lot worse than they were at any point this year, except perhaps the Rose Garden affair when he announced his tariffs.
David, you are painting a very bear case scenario for 2026. So I'm wondering about your thoughts for gold in 2026. A note from UBS yesterday highlighted that perhaps we could see a 5,000 handle for gold in the new year. I'm just wondering whether you think it could get higher than that.
I do think it'll get higher than that, and I think it'll get higher than that for a very simple reason. It is that China does about 50% of its own international trade in renminbi at the moment. That leaves it at the mercy of maverick policies by the United States, by President Trump. It's a major risk to do your trade in dollars, and because they go through American banks, and you can get into trouble there if the politicians decide you should. And so I think they'll push the renminbi up as a share of their trade quite dramatically next year, which will give us a very strong renminbi, of course, because there'll be demand for it. But a lot of the added value, the surpluses thrown off by that increased use of the renminbi won't stay in renminbi, it'll go into gold. And if you work out where that's going to come from, well, you've got 25% of international reserves today are in gold. I think by the end of the next year, it'll probably be 35%, and the gold price will be 6,000. That's how I get there.
Interesting. I would also like to get your thoughts on Europe for a moment. Kara and I have been discussing how strong 2025 has been for several markets in Europe. But in your notes, you're actually highlighting that you think European assets could be the losers in 2026. Highlight for us the reasoning behind that.
Okay, well, I'll focus on the reasoning behind that. By the way, this year, the European markets outperformed the United States by nearly double. And the reason for that is currency. The US markets may look fine in US dollars, but not if you're actually repatriating your gains in US markets into something like the euro. It's the rubbishing of the dollar, which is actually reducing the relative performance of the US equity markets to something like the second worst among the major blocs and only just ahead of India. So that's last year, which is already pretty amazing figures. Now, if you go out into next year and you look at Europe, well, if the flat world, which the major forecasters are forecasting, happens, then you could expect European equities to continue to do okay. And European bonds would be, on the way to nowhere because the budget deficits are far too high, but there wouldn't be a catastrophe. Where I think that could come unstuck is if the Europeans are forced by American withdrawal and Russian aggression to assume the cost of their own defense in an express fashion. In other words, not saying we'll reach 3.5% by 2035 or whatever, but saying, well, we'll have to get there next year or the end of this year. And at the same time, the Americans would, of course, not be supplying the European nuclear umbrella anymore. So you could add another 2 to 3% to European defense costs, 2 or 3% of GDP to European defense costs to build up their own nuclear umbrella. So that is the point at which the deterioration in the security situation in Europe starts to matter to markets a lot because it is economically highly significant. You can't just back away from it and say, well, it's the war in Ukraine, business as usual, let's fill our boots with some European equities. If this happens, you can't do that.
David, let me get to the very simple equation of what goes up must come down. And this is one of your points around the perfectly natural bursting of bubbles. You point to the non-bank financial credit area and AI. These have been well-discussed potential risks for the market. Everybody's concerned now that perhaps valuations are too stretched around AI. Will we justify the end based on some of the returns flowing through from the sector, productivity gains, and of course the non-bank sector as well? We've seen issues over the course of this year. It's not exactly a black swan if we know about it. So how do we think about whether these two events could prove meaningful for markets next year?
Well, you're perfectly right in saying that it's not an unknown unknown. It's certainly well discussed. In fact, there's a fair argument for saying there's a lot of bubbles in people talking about bubbles. There are so many people talking about them. But I would say to you this. I think my major concern about American AI is not that it is not productive or doesn't make life better, because I use this sort of thing every day and it does. My concern is that too much money has been poured into it in an indiscriminate fashion. And that actually, if you look across the Pacific Ocean to the Chinese, then the Chinese have created an equal or better mousetrap for something like 10% of the money. So my concern about the bubble in AI is not to call into question the nature and the productive heft to society which AI can potentially give. It is to call into question the way in which money has been thrown at it by massive egos without proper assessment. And I think that's where the bubble bursts. Now, of course, it's not a complete surprise, but there's nothing wrong with consensus provided it happens to be right.
This morning at OpenAI, and the average salary is being 1.5 million now. It's a bit like the heady days of banking, David. Let me push on to Japan, because at the start of 2025, some of us were concerned about the end of the carry trade, that perhaps Japan could be the one that rocks the market. But we didn't see that, so even though there was some tightening in policy. How does next year look any different? As you point out, Japan, the new locus of instability in Asia.
Well, there are several reasons for saying this. First of all, Japan was always a nice kind of neutral geopolitical entity on the edge of China's sphere of influence, which kept its head down and was reasonably well behaved if you happen to be Chinese looking at Japan. That's come to an end. You now have Takaichi is an extremely aggressive, hawkish prime minister who is going to achieve her defense targets as a percentage of GDP, not in 3 years, but by this time next year. And she is actually unleashing a wave of arming of peripheral islands very close to Taiwan, which is right in China's face. So the first thing you have to say is Japan is no longer that quiet little well-behaved tea party going on in the background. It's a pretty aggressive presence, and the Chinese aren't going to put up with it. So change in status. The second thing is that Takaichi's fiscal plans are, to put it mildly, complete rubbish. She's going to change a country with a debt to GDP ratio of sovereign debt to GDP ratio of between 200 and 245%, depending on how you judge it, which makes Italy look like Switzerland. And she's going to add to the primary budget deficit probably about 6% of GDP. Now, in order to do that, she needs the Central Bank of Japan to lower interest rates and print more money. She's not going to get it. So actually, one of the biggest battles about central bank independence will be in Japan. And if the Bank of Japan, decides to stand up for independence, which there's not terribly much sign of yet, that'll be one thing. If it does not, and it prints the money in one form or another, then you're going to see the investors take that out on the yen. Instead of lots and lots of money flowing back into the yen, you're actually going to see a weak yen backed by a compliant Bank of Japan, which will actually be printing money to fund an unsustainable budget deficit. That's why I think Japan is certainly, I'm not saying that's an absolute prediction. I'm saying it certainly doesn't look to me like you can simply say, look at Japan and say, like you did in previous years, oh, that's a quiet little place. That's nice. It'll just go on doing what it's always done, because it won't. It's going to be highly disruptive next year, one way or the other.
And David, this year, staying in the Asian equity space, this year we saw investors looking at China from different lenses here. I'm wondering, what are your thoughts for 2026, given that a lot of that is also related to AI? If we see a bubble bursting in the AI space, could that cap the performance for Chinese markets as well?
Of course it could. I mean, there's no such thing in my mind at the moment of equity diversification by owning the same or different sectors across different geographical areas. If the US market goes belly up, then don't worry, we're going to see it everywhere. But having said that, there are a lot of differences. Number one, China has won the trade war with the United States. You can see that right down the line. They've got exactly where they want. The US thought they could stand up to China. China cut back on the rare earths and so on, and the US capitulated. Now they're even selling them the sort of chips they want to own. So what do I think is going to happen? I think Chinese growth is going to be non-spectacular, 4.5% or 5%, and it doesn't really matter. What does matter is that Chinese equities are still, they've had a terrific year, but they're still only about 14 times earnings. And even if you look at the Alibabas and the sort of AI type stocks you would want to own in China, you have two things going for them. One, their equity ratings are about 50% of those in the United States, their peers. And second of all, of course, they have paid immensely less money to set up all these AI instruments and apps than the United States has. So I would say, even on the back of moderate growth, I think people are going to reassess China. And my other reason, just the last one, is to hark back to what I said before. I think the internationalization of the renminbi will result in additional currency flows into the Chinese economy, which will be an increase in liquidity, which will drive up asset prices, principally equities. So that's where I stand on China.
The Chinese have been planning for that for a long time, haven't they, David? Now, we do appreciate your thoughts today. You've given the audience a lot to think about and debate into the new year. We do appreciate your time. Happy New Year to you. David Roach with us, President Quantum Strategy. Coming up on the show, minutes from the Fed's December meeting show a tighter than expected call on cutting rates. We'll have more next.
I'm Steve Sedgwick from CNBC, and in my new podcast, Executive Decisions, I ask powerful leaders about their decisions that changed everything.
I'm not frightened of making tough decisions, and I think leadership can be very lonely.
Business leaders should not stay quiet in a world which is super complex.
It is absolutely fine to also change your mind.
Tough calls, personal crossroads. These are the stories that we can all learn from. It's Executive Decisions from CNBC. Get it wherever you get your podcasts.
Welcome back to the program. Now, it has been an eventful end to one of the best years on record for metals, with the likes of silver, gold and platinum back under pressure this morning. A combination of geopolitical tensions, supply pressures and industrial demand have driven prices up, with one analyst calling the moves historic. So let's take a closer look at this space. Worth keeping in mind indeed that yes, we have witnessed a pullback in recent hours, but the year-to-date performance is still very strong for this part of the market. Gold up by about 65%, silver almost up by about 150%. Copper also making gains of about 40%. A lot of reasons behind some of this momentum for the different metals here. One of them, of course, is related to expectations of further demand coming from the fact that AI is requesting more metals, including for the buildup of further data centers. There's also considerations around geopolitical concerns that have also fueled the metal space, in particular for gold. So let's see what will happen in the new year. But so far, Karen, looking at their performance in 2025, no doubt that we are looking at very, very strong numbers.
Well, meantime, the minutes from the Fed's December meeting have revealed the decision to cut interest rates was a much closer call than the final vote indicated. The minutes said that those who voted to cut rates said the move was finely balanced, amid indications that the vote could have gone either way. There were also questions over how aggressive the FOMC should be, saying for some that it would likely be, quote, appropriate to keep the target range unchanged for some time. For me, the takeaway was, if in doubt, cut, which is what they did. Former Fed Governor Frederic Mishkin has told CNBC he would lean towards holding rates given the outlook for the wider economy.
I would tend to be on the hawkish side. I mean, because of the fact that inflation is still above the Fed's target, and it's really slowed down its progress towards getting towards the target. But also the labor market's been weakening a little bit, but the economy's still pretty solid. So when you put all those things together, it's sort of a 50-50 type deal. You know, I would sort of lean to not cutting rates.